In today's financial landscape, where the average American juggles various forms of debt, from credit cards to mortgages, the quest for the most efficient and cost-effective borrowing options has never been more critical. According to recent data, the total household debt in the U.S. has soared to a staggering $14.56 trillion, with mortgage debt leading the charge. Amidst this backdrop, individuals are constantly seeking flexible and affordable ways to finance their dreams, whether it's renovating a home, consolidating debt, or covering unexpected expenses. But here's the million-dollar question that many of you have been asking. Should I go for a HELOC or a personal loan? It's a fantastic question, and the answer can significantly impact your financial health and flexibility. So, buckle up as I dive into the nitty-gritty of HELOCs and personal loans, comparing their features, benefits, and potential drawbacks. I'll explore everything from interest rates and repayment terms to eligibility criteria, helping you make an informed decision that aligns with your financial goals and lifestyle. Whether you're a homeowner with equity to spare, or someone looking for a straightforward borrowing option without collateral, I've got you covered. Stay tuned as I unravel the mysteries of HELOCs and personal loans, guiding you towards making the best choice for your financial future. Let's get started and unlock the door to financial flexibility together. Difference between HELOC and personal loan. Interest rates. Interest rates are a critical factor when comparing HELOCs and personal loans. HELOCs typically offer lower interest rates because they are secured by the equity in your home. This security reduces the risk for lenders, which is reflected in the cost of borrowing. Interest rates on HELOCs are often variable, meaning they can fluctuate over time with market conditions. Personal loans, on the other hand, usually have higher interest rates because they are unsecured. Lenders take on more risk without collateral to back the loan, which results in higher rates for the borrower. Personal loan interest rates can be fixed or variable, but fixed rates are more common, providing predictable monthly payments. Qualifications. Qualifying for a HELOC often requires having sufficient equity in your home, a good credit score, a stable income, and a low debt-to-income ratio. Lenders will typically require an appraisal of your home to determine its value and the available equity. For personal loans, qualifications are primarily based on creditworthiness, including credit score and history, income, and other debts. Collateral is not required, so the focus is on your ability to repay the loan based on your financial history. Collateral. The most significant difference between HELOCs and personal loans is collateral. A HELOC is a secured loan, with your home serving as collateral. If you default on a HELOC, you risk foreclosure on your home. Personal loans are typically unsecured, meaning they do not require collateral. This can be advantageous for borrowers who do not own a home or do not want to put their home at risk. However, defaulting on a personal loan can still have severe consequences, such as damage to your credit score and legal action from the lender. Loan amount. So, personal loans are pretty flexible. You can snag anywhere from $1,000, $1,000 to a hefty $100,000. But keep in mind, a lot of lenders might cap their loans at around $50,000. Now, if you've got a solid credit score, a stable income, and your financial house is in good order, you could be looking at getting approved for the higher end of that range with some sweet rates to boot. On the flip side, HELOCs are like the big kahunas of the loan world because they're tied to the equity you've built up in your home. That means you could potentially borrow way more. We're talking several $100,000, and in some rare cases, up to a cool $1,000,000. If you're planning to give your home a makeover or tackle some major renovations, a HELOC might let you borrow more moolah than a personal loan. Repayment terms. HELOCs usually have two phases, a draw period and a repayment period. During the draw period, you can borrow funds up to your credit limit and make interest-only payments. After the draw period ends, you enter the repayment period, where you pay back the principal and interest. This structure provides flexibility but can lead to higher costs if the balance is not paid down before the repayment period. Personal loans have a fixed repayment term, typically ranging from 1 to 7 years. You make regular monthly payments that include both principal and interest, which allows for a clear payoff date and can be easier to budget for. Fees. The extra costs to keep in mind. Alright, let's break down the fees. Both personal loans and HELOCs might come with their own set of fees, kind of like when you buy a concert ticket and they slap on those extra charges at checkout. For personal loans, you might see origination fees, which is basically the lender's way of saying, "Hey, it costs us money to set up your loan." Some lenders are chill and might skip these fees, but it's always good to ask so you're not caught off guard. Now, HELOCs can feel a bit like when you're at a fancy restaurant and they charge you for every little thing. You might run into appraisal fees because they gotta check out your home's value, application fees just to throw your hat in the ring, points, which are kind of like prepaid interest, attorney fees for the legal stuff, title search fees to make sure your home is really yours, document fees for all that paperwork, taxes because, well, taxes, annual fees or account maintenance fees, kind of like a subscription to keep your HELOC going. But here's a little insider tip. Some lenders might be willing to waive some or all of these fees. It's like getting a backstage pass. Not everyone gets one, but it doesn't hurt to ask. Tax incentives. One advantage of HELOCs is the potential for tax-deductible interest if the funds are used to buy, build, or substantially improve the taxpayer's home that secures the loan. However, tax laws are subject to change, and you should consult with a tax advisor to understand current benefits. Personal loans generally do not offer tax incentives for interest paid, as the interest on unsecured loans is not typically deductible. Credit risk for default. Defaulting on a HELOC can lead to foreclosure since your home is used as collateral. This makes the credit risk for default particularly high with a HELOC. With personal loans, defaulting can lead to a damaged credit score, increased interest rates on future loans, and potential legal action. While the stakes are not as high as losing your home, the repercussions can still be significant. Typical loan limits. HELOCs often have higher loan limits due to being secured by home equity. Some lenders may offer HELOCs up to several $100,000 or up to 65% of your home's value. Personal loans have lower typical loan limits, with many lenders capping loans at around $50,000, though some may offer up to $100,000 for borrowers with strong financial profiles. Uses. HELOCs are commonly used for ongoing expenses or large projects, such as home renovations or education costs, due to their higher loan limits and flexible draw periods. Personal loans are often used for one-time expenses like debt consolidation, medical bills, or weddings, offering a fixed amount of money with a clear repayment schedule. Time to fund. HELOCs can take several weeks to process due to the need for home appraisals and the more complex approval process. Personal loans typically fund more quickly, sometimes within a few days, making them a good option for those who need funds promptly. Credit impact. Both HELOCs and personal loans can impact your credit score. HELOCs can affect your score through the initial inquiry, the increased debt load, and any changes in utilization. Personal loans also affect your score but can be used to consolidate debt, which may improve your credit utilization ratio. Approval process. The approval process for a HELOC is more involved, requiring an appraisal of your home, verification of income, and assessment of your credit worthiness. Personal loans usually have a simpler approval process, with decisions often based on credit score, income, and debt-to-income ratio. Risk of debt cycle. HELOCs carry the risk of a debt cycle, especially during the draw period, if borrowers continue to borrow against their home equity without paying down the principal. Personal loans have a set repayment term, which can help prevent a debt cycle, but rolling over or taking out additional loans can still lead to a cycle of debt. Here's a comparison table summarizing the key differences between HELOCs and personal loans. How to choose between a HELOC and a personal loan. Deciding between a home equity line of credit, HELOC and a personal loan can feel like a big decision, but don't worry. I'm here to help you navigate through your options with some friendly advice. Let's chat about what might work best for you by considering a few key points. First off, do you own a home with some equity built up? If not, then a HELOC might not be in the cards since it requires you to use your home's equity as collateral. No home means no HELOC, but that's okay because a personal loan could be a great alternative. For those who do own a home, make sure you've got enough equity, typically around 20% if you're in Canada. Remember, using your home as collateral means it's at risk if you can't repay the loan. So if that thought makes you uneasy, a personal loan could be the way to go. Now, think about what you're aiming to achieve. Are you looking at a one-off expense that's under $50,000? A personal loan is straightforward and might just fit the bill perfectly. On the other hand, if you're dreaming of multiple big projects, like home improvements that'll span over a year or so, a HELOC's flexibility with its revolving credit might be exactly what you need, especially when the total cost isn't clear from the start. Lastly, let's talk interest rates. Because HELOCs are secured with your home as collateral, they often come with lower interest rates compared to unsecured personal loans, assuming your credit score is in good shape. But if the idea of putting your home on the line makes you nervous or you simply don't have the collateral, an unsecured personal loan could be your best bet. In essence, the choice between a HELOC and a personal loan boils down to your unique situation, what you own, what you need, and how you feel about interest rates and risks. Take a moment to reflect on these points, and you'll be well on your way to making a decision that feels right for you. Remember, it's all about finding the option that aligns with your goals and gives you peace of mind. And there you have it, folks, the ultimate showdown between home equity lines of credit, HELOCs, and personal loans has come to a thrilling conclusion. We hope this deep dive has illuminated the path for you, answering that burning question and equipping you with the knowledge to unlock your financial flexibility.